What's up, guys? Welcome back. It's your friend Nate again. Today I got a question about bonds. What is a bond, right? So I'm sure you guys hear it all the time about long-term interest rates and so on. And those are essentially the different rates of interest in exchange for purchasing bonds. And a bond is simply just a loan, right? You're just giving a loan to the government, and it's just got a coupon value on it. So same thing with CDs, right? So you can go to the bank, you have certificates of deposit, you guys work out an interest rate that the bank is offering, and you can purchase CDs. Usually they're lower percentages than bonds, and it works the same way that those do, right? So you're giving the bank a little loan, certificate of deposit, they're paying you a little bit of interest, right? It's very safe. So the risks are very low with that. And then you have bonds, which is just municipal bonds, government bonds. So you have bills, notes, bonds. They're all just different lengths of time that you are loaning the government money. And they just have an annual percentage rate that they pay you in exchange for you purchasing that long-term loan with them. Now, also, I know I've talked in other videos why I don't invest in bonds right now. So the reason why I'm not investing in bonds is because of how expensive bonds are relative to their return and the opportunity cost by buying a bond instead of other investments that are out there. Now, on the pro side of bond investing is that you're going to get paid the money, right? Now, you can't guarantee the purchasing power of the money that you receive long term because of inflation and so on. But more than likely, you are going to get paid out the coupon numerically that you were promised, right? So the issue, though, with bonds in general is that because they're fixed income, they just offer lower returns. That's why they call it the risk-free rate. So because risk isn't perceived, people will buy government bonds, and they accept a lower rate of return, which if you need fixed income, and if you can live off that income, then it really does make sense for some people. I would also argue, though, as some of the greatest investors in the world have pointed out, that relative to other investment opportunities, looking through all investments through the same lens, bonds are a very low return investment. Right? So if let's say, for example, if interest rates are at 2%, that is the equivalent of paying a 50 times current earnings for a public company, which would be expensive, and we really wouldn't do that, right? So again, the reason why a lot of the greatest investors of all time don't invest in bonds on a regular basis is just because the return on interest is so low. And so again, if you're focusing on higher returns, it's going to naturally disqualify bonds from your portfolio because of the opportunity cost associated with that level of certainty. And so that's just something to keep in mind, looking through things from the same lens. How many multiples of cash flow are you paying for an investment? Well, a 2% bond would be like paying a 50 times free cash for a publicly traded company. That would be too expensive for us, right? So if we're not going to pay a PE of 50, then we're not going to buy a 2% bond. So anyway, I hope this cleared that up for you guys of why I don't really believe in bond investing and why I think that publicly traded stocks offer higher returns and lower risk.